One of the numbers that I see contractors often calculate incorrectly is their overhead break-even percentage. Now, a lot of people think that it's just that number on your profit and loss statement, but honestly, if that's the number you're using for calculating your overhead markup, you are losing money. And in this video, I'm going to show you how to calculate the right overhead break-even percentage for your business. Hi, I'm Vicki Suter with Suter Business Builders. And for over 25 years, I've been helping contractors build more profitable and sustainably successful businesses, helping them discover how to get more time in their day and to reclaim the joy and the fun in what they do again. And one of the key ways that I help them do that is helping them have a better understanding of their numbers and how to really harness the power of their numbers and make better decisions about how they're bidding or how they're managing their business by helping them have a greater sense of clarity so that they have more confidence so that they can take more powerful actions. And in today, what I want to show you, and I'm going to share my screen here in just a second, but I want to show you what is often a common mistake that contractors make when they look at their profit and loss statement. And, if you run it out of QuickBooks or whatever your software is, and you see a percentage next to the numbers, and a lot of times people think, well, that percentage next to my total overhead expenses or total expenses must be my percentage that I have to mark up to cover overhead. In fact, that is not the number, and that number is way too low. And if that's the number that you've been using, it could very well explain why you're not making as much money on the bottom line as you would like to. So what I'm going to do is I'm going to walk you through how to calculate that number for yourself, whether you're a general contractor or a subcontractor. I'll show you both examples. And I will show you a few other key numbers that are probably good for you to track when you're looking at the profitability of your business. So let me just jump in and share my screen. I'll start with the example here of a general contractor. So this is a general contractor profit and loss statement. And as you'll notice in this column, there's numbers, and in this column AD, there's percentages. And those percentages represent what that dollar amount is as a percentage of total income. So in other words, this 2,499,839 is 96.66% of 2,586,280, right? And if I look at material costs here of 325,000, that's 12.57% of total income. Right. So there are four key numbers when you're looking at your profit and loss statement that you want to pay attention to. And I'm going to briefly walk through each of these with you because they relate to this whole thing about looking at your overhead break-even percentage. So one of the numbers that everybody looks at is income, right? We tend to pay attention to how much did we sold, how much did we produce, but we don't necessarily pay as much attention to gross profit margin. That's the second really key and critical number on your profit and loss statement. And your gross profit margin is your margin, by definition, simply means your rate of return. A margin is a percentage. And contractors live and die by gross profit margin. So having a target and a goal for gross profit margin is critically important for your business. Now, I have other videos that I've recorded on this topic of how to read financial statements about markup margin. So I'm not going to get deep into that topic right now, but I will just say that when we look at how much do you have to mark up to cover your overhead, it's important that you have a goal for how much you want your gross profit margin to be, because it also impacts how much you mark up for profit as well, right? So gross profit margin in this case for this general contractor is 34%. For a company that does 2.5 million, that's a decent gross profit margin. You should be looking at around 35%. I will say one thing though, if you do really small jobs and they're service jobs, you should actually have a much higher gross profit margin, somewhere between 35 and 40%. But that's a deeper topic than we're going to go into today. All right, so then you have the costs of running your business, right? So this is your overhead cost. So when we look at overhead costs, that includes things like I said, rent, utilities, telephone. your salary as an owner, estimator salary, part of the non-billable portion of your field labor, that kind of thing. And then you get your total overhead, including vehicle depreciation or other depreciation. And then you've got your total overhead expenses for general and administrative expenses. And then you have administrative expenses in this particular case for owner salary. So if you're a smaller business, when you're calculating this number, I'm going to show you in a second for your overhead break-even percentage, it's critical that even if you're a sole proprietor and you don't have a salary that goes through your business, your compensation should be taken into account when you're calculating this number for yourself. Super important, okay? In this case, this company, the owner takes a salary and they're in there as part of their compensation. So then you have total overhead and administrative expenses, in this case, $622,000. Now, remember I said, when you look at the profit and loss statement, there's a percentage on there. And in this case, that $622,000 represents 24% of revenue. But that's not the overhead break-even percentage. The overhead percentage, what that overhead percentage is, this company needs to mark up their bids just to make nothing on the bottom line, is 36.51%. So let me show you how I got that formula. I took total overhead expenses. So actually redo it over here. Total overhead expenses, I click on that number, and then I divide it by cost of goods sold, 1,704,000. Let's change that to a percentage. And there's your 36.5%. So you can see that makes a huge difference if I'm marking it up 24% versus what I should be marking it up 36.5%. So if you want to make a consistent profit, it's critical that you first understand what your overhead break-even percentage is and make sure that your bids accommodate for marking up for at least that amount. Now, I want to speak about two things here for a second. One is, I hear all the time people throw around this number of like, well, it's 10 and 5, like markups, right? Like 10 and 5 or 15 and 10 or, just random numbers. And oftentimes I hear contractors say, well, I can't be competitive in the marketplace if I showed 36.5% markup. And I totally hear that. And so some of the things that you're going to want to do is look at, okay, what is my labor when I'm bidding is my biggest risk factor. I'm going to have a higher markup on my labor than I am on other line items. Or you maybe want to include some of the items in your overhead expenses in general requirements, things like project accounting or supervision, or other, travel time, equipment, tools, anything else, safety meetings, right? Anything that will require your overhead expenses to be put towards that are really job expenses, but really too complicated to be able to try to burden the jobs with those specific costs, like just to break them down, right? So including some figure in there is a way that you can reflect your overhead costs in your bid to cover some of those overheads so that you're not showing a number of 36.5%. Because I got to tell you, I've been doing this for over 25 years, and I promise you, unless you're a really large contractor doing in the multi-millions of, and I'm talking about like 50, 75 million in revenue, your overhead percentage is not 10%. If a general contractor has enough volume, that's possible, but it's not probable. So one of the things that I would caution you about is to just not listen to that and really let the numbers be your guide, right? It's that whole thing of when you have clarity, you have more confidence. When you have more confidence, you can take more powerful actions. So what you want to do is be really clear about what that number is for you. Now, I recommend that you measure this for at least a 6-month period of time and ideally a whole year. And there's a couple things that are important in order to have this number be correct when you calculate it. One is that when you look at your cost of goods sold, that it actually reflects all of the costs related to production and that it doesn't reflect overhead costs. So in other words, sometimes I notice that labor gets lumped either all into cost of goods sold or all into overhead expenses. that should be split out, right? Even if you have to manually calculate it and go, here's officer's salary, that doesn't belong in cost of goods sold, or my office manager, or my estimator, whatever that is. So you might have to adjust your numbers on your profit and loss statement to get an accurate number. But I highly recommend that you do that because it's worth the exercise, even if you have to do it manually. And also what that will do is it will help you get a better grip on your gross profit margin and let you see if you're getting a decent rate of return. By the way, there's a little trick here that if you want to see what your overall markup is on jobs, if you take your gross profit dollars and you divide it by cost of goods sold, that will tell you what your overall markup is for the result based on the work that you've actually completed. So that can actually be a little bit of a guide to you to let you know if you're marking up enough, because it could be that you're not, right? So I told you there were 4 key numbers. So revenue, gross profit margin, your overhead break-even percentage, and then your net income from operations. This is before taxes, before any miscellaneous income that's not related to operational. It's like a one-off. That is, in this case, $260,090, 10.06%. A good goal is to have this be between 8 and 10% minimum, 10 and 12% ideally. This is for most general and subcontractors doing under about 20 million a year. Once you get past that level and you get to a higher level, and even you could say 15 million a year, you're probably going to have a lower net profit margin. But if you're a smaller contractor, that's a good goal to go for. All right, so this is a general contractor example. Let me just show you on a subcontractor what that might look like. So a subcontractor, again, revenue number 1.9 million. You see the percentage of income here in this column. And then gross profit margin, you'll notice the gross profit margin is a little bit higher. It's about 40%. Subcontractors generally have a higher gross profit margin because they also have a higher overhead structure. Again, more often than not. Why? Because generally they have more employees. There's more costs for administering and managing a subcontracting business than there is generally for a general contracting business. Again, it can vary if you do all your work and it's self-performed. It could be that it's a little bit closer to looking like this. You're going to have higher gross profit margins if it's self-performed work or if you do service work. If you are a subcontractor, though, generally, whether you do, I will say, if you're a subcontractor and you do service work, you might find that that gross profit margin is even higher, but you also will tend to have higher overhead expenses when you take into account you've got somebody who's doing dispatch and work orders and collections and that kind of stuff, because it takes more labor to process a larger number of transactions, right? So gross profit margin, just like general contractors, subcontractors live and die by gross profit margin, critical number to track in your business. And then I did the same thing down here. So I calculated what was the overhead break-even percentage for this subcontractor. I take total overhead expenses and divide that by cost of goods sold. That's 1,166,000, and it's 46.2%. Now, just like the general contractor, if I look at the profit and loss, it shows 27.57%. But in reality, the subcontractor has to mark up at least 46% just to break even. That means that markup, and this is true general or sub, that when you look at your overhead break-even percentage, what it means is that's how much I have to mark up just to have nothing on the bottom line. And just like a general contractor, I recommend that you make sure that what's in your cost of goods sold is truly just the costs related to producing that work. And again, in this case, if I were to look at this subcontractor, what's their overall markup? I take their gross profit dollars, divide it by cost of goods sold. Their overall markup is 67%, 67.5%. So Again, other key number you want to look at down here is net ordinary income. Goal 10 to 12% when you're talking about a company this size. If you're much larger and you're a subcontractor, that could go down, right? So those are just a few key numbers for you to keep in mind that can help you when you're bidding to make sure that you're stacking the odds in your favor of making a consistent profit. Now, one of the other things I would recommend is that it's a good idea that before your bid goes out, to double check that bid and make sure that you're reaching your gross profit margin goal overall. So that means I know what my real hard cost is for labor, materials, equipment, subs, other. And then I'm calculating what my sales price is, less that cost of goods, less the direct expenses for producing that work, giving me then a gross profit dollars number. And then gross profit margin is calculated by taking those dollars, dividing it by revenue. That's your rate of return or your gross profit margin number. It's a really good practice. What I've found is that clients of mine who do that on a consistent basis make a more consistent profit, right? Because you're stacking the odds in your favor before that bid ever goes out to make sure that you're making a decent gross profit margin. All right. So I would highly recommend as your next step is go calculate this for yourself. Go take your own data and look at these numbers. You want to look for at least a 6-month period of time, ideally a 12-month period of time, and make it more recent because as your business shifts, your overhead cost structure shifts, right? And one final reminder is that if you're a sole proprietor and you don't have a salary in there, make sure to add your salary to those overhead costs to figure that dollar amount in when you look at how much do I have to mark up to make a profit or just to break even. Okay, so go do it. Feel free to leave a comment below. I would love to hear your thoughts about this. Was, any ahas, anything that you've learned that would be helpful for somebody else? That would be great to drop a note below. Thanks for being here today. I will see you next time on The Profit Builder.